Before we begin, this presentation is for educational and research purposes only. It is not financial, investment, legal, or tax advice, and nothing here is recommendation or solicitation to buy, sell, or hold any security or options contract. Examples are simplified and illustrative. Options involve substantial risk, may not be suitable for all investors, and may result in the loss of the full amount committed to a defined risk position. Hello everyone, this is Saurabh. Welcome to the Options Engineer channel. In this session, I cover a historical backtest and research-only comparison between Skyline 14DTE version 1.0 and a 40-point Condor. Both structures are 14DTE in this research. The high-level overview is simple. Similar capital at risk neighborhoods, similar target dollar anchors, and very different return paths. The clean anchor is the Skyline at 10% versus the Condor at 15%. That gives us roughly the same target dollars, about 300, and lets us compare how the structure design, capital at risk, and exit in engineering influence the portfolio path. Here is the session flow. First, I will frame the backtest comparison, Skyline 14DTE version 1.0 versus 14DTE 40-point Condor over the post-tariff research window. Second, I show the quantitative layer, debit, premium, target dollars, model, capital at risk, drawdown, MAR, Sortino, and days in trade. Then I move into the demo, connect the structure design to the metrics, and close with the key takeaways. This is a research walkthrough built for education. Some of the aspects around MAR and Sortino I will cover in the demo. This is the key exit math slide. Skyline averages about $3,000 of opening debit for one lot or contract, while its model CAR for this analysis is framed at about $2,000. The 40-point Condor is also framed at about $2,000 debit and capital at risk. That gives us a clean bridge. 10% of Skyline is about $300, which lines up with about 15% on the Condor. 20% on Skyline is about $600, which lines up with about 30% on the Condor. And Skyline at 20% versus Condor at 80% becomes the best outcome research comparison. The percentage differ, but the economics becomes much clearer. Here the point is capital efficiency. Skyline may deploy around $3,000 of debit, but the risk framing we are using is about $2,000 of capital at risk / max loss. The 40-point Condor is also framed around $2,000 of debit and capital at risk. So the risk comparison is already closed. Then we add time. Skyline averaged about 4.8 days at the 10% exit and about 9.4 days at the 20% exit. The Condor ranged from about 6.3 days at 15% to about 13 days at 80%. So capital efficiency is not just how much is deployed, it is about how much is deployed for how long and with what path of drawdown. In the demo, I connect the payoff map to the metrics. I will show how the structures cover a comparable risk neighborhood, how the target dollars are created, and how the exit logic changes the outcome. The point is not to reveal exact strikes or template. The exact Skyline structure is intentionally abstracted because the session is about the options engineering process. The point is the method inside options engineering OS, define the structure, quantify the risk, analyze the execution logic, and evaluate the result as a portfolio path. We are on the options engineering OS. So here we are comparing the payoff graph of the Skyline 14DTE version 1.0 and 14DTE Iron Condor 40-point, starting from the spot of the market, and it's the wings are 40-point wide here. You can see 7675, 7715, and 7860. And 7900. Both of them have a similar range. And looking at here for the Skyline, today's illustration, these numbers can change based on day volatility and other option aspects. But just for an illustration standpoint, we are looking at 14DTE and 15DTE analysis is shown here because we are on a weekend Sunday. So I'm looking at 2 weeks out Monday. We can see the net debit is around $3,000 and capital at risk is $1,655 for this instance. I've averaged this to 2,000 in the presentation, and for net debit is 1940 for Condor, and the capital at risk is 1940 as well, which how we comparing the two structures and averaging the capital at risk at $2,000 for the time frame that we are looking at from the backtesting and research standpoint. Now I'll move into some of the backtest details. Here we are on the options Omega, which is a backtesting tool I use. I am not affiliated with them for my analysis. So for 10%, we can see some of the results here as a backtest research with $25,000 capital, and deploying the Skyline versions mostly every day without any key parameters that are restricted here, and with a 10% profit target. Now we are looking at the Skyline 14 DTE version 1.0 with a 20% profit target, and we can see some of the results here, and the overall capture rate is around 17,000 and overall ending capital is 186,559. The drawdown is 9.71% and MAR ratio is 38.9%. This is one of the best configuration for this version of Skyline, and the time frame we are looking at is from May 1st, 2025 to August 14, 2026. Now we are on the 40-point iron Condor, and the same time frame as Skyline, and it's a 40-point from the center spot. And the same characteristics were used for the Skyline as well from the opening trade standpoint. And here we are looking at the 15% target for exit, and then the opening fees and closing fees are used similarly in the Skyline as well of $1 per contract. So this is the details with the 15% target for the iron Condor 40-point wide here. Now we are at a 30% configuration of a profit target, and we can see average days in the trade in this case are 9.2, and the capture rate and other ratios are shown out here as well. And this is the graph here. Now we are looking at 80%, 13 days approximately here highlighted, and the win percentage is 61.4%, and ending capital is 105,000 for a starting capital of 25,000 and a P&L of 80,603. So based on different configurations tried on the 40-point Condor, the 80% profit target showed the best P&L, but the number of days in the trade were higher. This is the bridge from the demo to the metrics. Skyline 14 DTE version 1.0 is used here as an illustrative engineer structure, not as a trade template. It is built through options engineering OS from familiar defined risk building blocks and evaluated through a quantitative layer. That layer includes payoff geometry, capital at risk, scenario testing, execution feasibility, and lifecycle fit. The platform also supports the execution side of the process. So the message is that the structure is designed and evaluated through a research workflow, not just only by its label. This is the core comparison slide. Pair 1 is the clean equal target dollar anchor Skyline at 10% versus Condor at 15%. Pair 2 keeps the same logic at the next level up, Skyline at 20% versus Condor at 30%. Pair 3 compares the best outcome research framing, Skyline at 20% versus Condor at 80%. Across those views, the important audience message is that structure design plus exit engineering can create very different return paths even when the car neighborhood is similar. The key takeaway is that a structure is not just a trade. It is a risk engine. Structure design, quantitative analysis, capital at risk, and exit engineering can create very different portfolio behavior from the same SPX range. Thank you for watching. Please visit theoptionsengineer.com for more educational and research content. These are hypothetical historical backtests, not live performance, not financial advice, and not a guarantee of future results.